The capital was your problem. You would be profitable by now. Not someday. Not once you scale. By now. Because you've already tried the solution you keep blaming everything on. You've added more money. You've reset accounts. You've passed challenges. You've topped up after losses, convinced that this time, with just a bit more capital, it would finally click. But it didn't. And that's uncomfortable to admit. Because if capital truly was the issue, then progress would be linear. More money in a better results out. That's how real limitations behave. But that's not what happened, is it? You didn't suddenly become calmer with more money. You didn't become more patient. You didn't start following rules more consistently. In fact, if you're honest, the problems got bigger. A bigger size didn't bring clarity. It brought fear, overconfidence, and impatience. Sometimes all three. So let's say this plainly without sugarcoating it. If capital were your problem, the market would have rewarded you the moment you increased it. But instead, the same patterns followed you. The same mistakes. The same emotions. The same rationalizations after the damage was done. Which means capital isn't the bottleneck. Something else is. And that realization is dangerous. Not because it's false, but because it leaves you with nowhere to hide. You can't outsource it. You can't borrow your way out of it. You can't fund your way past it. It lives in how you execute, how you manage risk, how you behave when you're winning, and especially when you're losing. Most traders don't fail because the market is unfair. They fail because the mirror the market holds up is one they don't want to look into. And today, we're going to talk about it. There is a belief almost every struggling trader carries, whether they admit it out loud or not. I'm not bad at trading. I'm just undercapitalized. It sounds reasonable. It even sounds responsible. After all, in most areas of life, more resources usually mean better results. If you had more money, you could take cleaner setups. If you had more money, you wouldn't need to overtrade. If you had more money, you could finally let trades breathe. That story feels logical. And that's exactly why it's so dangerous. Because what's really happening isn't a capital problem. It's an assumption problem. Somewhere along the line, traders begin to equate money with competence. They start believing that account size is a reflection of skill, when in reality it's often just a reflection of access. Access to savings, access to leverage, access to a prop firm challenge. But access is not mastery. A larger balance creates the appearance of professionalism. The numbers look serious. The platform feels important. The stakes feel real. And that creates an illusion of safety. Bigger balances make traders feel protected. Like they have a cushion. Like mistakes won't matter as much. But that feeling is false. Because the market doesn't care how large your buffer is. It only responds to behavior. And behavior doesn't magically improve with more money. In fact, it usually gets exposed. Think of it this way. If you put the same driver behind the wheel of a faster car, you don't suddenly get a better driver. You get the same habits at higher speed. Late braking becomes catastrophic. Overconfidence becomes fatal. Small lapses in judgment become irreversible. Trading works the same way. When capital increases, your habits don't disappear, they get louder. If you overtrade on a small account, you'll overtrade with more confidence on a big one. If you revenge trade with little money, you'll revenge trade with larger losses. If you hesitate, chase, or panic, you'll do it with higher stakes and heavier consequences. This is why so many traders are shocked when larger accounts perform worse than smaller ones. They expect relief. They get pressure. They expect control. They get exposure. Because capital doesn't fix bad trading. It gives bad trading more room to hurt you. The market doesn't see your balance. It sees your decisions. And if those decisions aren't grounded in discipline, patience, and restraint, then more money doesn't solve the problem. It accelerates it. This belief that capital is the missing piece is what keeps traders stuck in a loop. A loop of topping up, starting over, and hoping the next increase will finally be enough. But the truth is uncomfortable. The same trader with the same habits placed in a bigger account doesn't become safer. They become faster on the same road, with the same blind spots, heading toward the same outcome. And until that belief is dismantled, no amount of capital will ever be enough. Capital becomes the scapegoat not because it's accurate, but because it's comfortable. When a trade goes wrong, the mind looks for the fastest way to protect itself. Not to improve, to survive. And the easiest thing to protect is the ego. Admitting that capital is the issue allows you to stay competent in your own story. It lets you believe the problem is structural, external, and technical. Something that can be solved with funding, leverage, or one more reset. But admitting that you are the issue, that your decisions, your reactions, your discipline are inconsistent, that's threatening. Because it doesn't come with a quick fix. Ego doesn't mind losing money. It minds losing status. And in trading, status is tied to identity. Being a good trader. Being almost there. Being profitable. Just underfunded. So capital becomes a shield. A way to explain losses without questioning competence. This is where avoidance creeps in. Self-assessment is hard work. It requires slowing down, reviewing mistakes, and sitting with uncomfortable patterns. It means looking at trades not as isolated outcomes, but as expressions of behavior. Most traders don't avoid this because they're lazy. They avoid it because it's destabilizing. When you really assess yourself, you can't hide behind the market anymore. You see how often you break rules when you're bored. How quickly you abandon plans after a loss. How easily confidence turns into recklessness. That kind of honesty threatens the image you have of yourself. So instead, the failure gets externalized. The spreads were bad. The market was manipulated. The session was choppy. The account was too small. Notice how all of these explanations share one thing. They remove responsibility without sounding irrational. Blaming capital feels logical. Blaming yourself feels threatening. And because it sounds logical, it rarely gets challenged. There's even a quiet dignity to it. I would be consistent if I had more capital. I can't trade properly at this size. I'm limited by my account. It sounds mature. It sounds measured. But it's still avoidance. Here's the uncomfortable truth. If discipline only appears when money is abundant, it isn't discipline. It's relief. And relief doesn't last. This is why traders keep chasing bigger accounts instead of better habits. It's easier to raise money than raise discipline. One requires paperwork and patience. The other requires restraint when no one is watching. So capital becomes the story you tell yourself and others because it protects your identity while explaining your results. It allows you to fail without feeling incompetent. To lose without feeling exposed. And that's why it sticks. So capital becomes the excuse that sounds responsible. When most traders talk about skill, what they're really talking about is knowledge. Strategies, setups, indicators, entries and exits. They assume that if they just learn enough, if they find the right model, the right system, the right combination of rules, everything else will fall into place. But that's not how trading works. Because the market does not reward what you know. It rewards what you can execute consistently under pressure. This is the first reframe that has to happen. Skill is not strategy. Skill is behavior. A strategy is static. You are not. You bring emotion, impatience, fear, confidence, and ego into every decision. And those variables matter far more than the logic of your setup. Real skill shows up in places most traders don't like to look. It shows up in risk control when you're confident. Anyone can manage risk when they're scared. Fear naturally makes you cautious. But confidence is dangerous. After a win or a streak of wins, rules start to feel optional. Position size creeps up. Stops widen just this once. You feel in sync with the market. Skill is the ability not to betray yourself in that moment. To execute the same way you would on your worst day, even when everything feels easy. Then there's patience when you're bored. This is where most traders quietly fail. The market isn't always moving. Sometimes it ranges. Sometimes it does nothing. Sometimes your setup just doesn't show up. Boredom creates pressure. And pressure creates bad trades. Skill is not forcing activity to feel productive. It's being comfortable doing nothing while everyone else is clicking. If you can't sit through quiet periods without manufacturing opportunities, you don't lack setups, you lack discipline. And finally, there's consistency when nothing is happening. Not when you're winning, not when you're losing dramatically, but in the long, uneventful middle where trading actually lives. Consistency is repeating the same process even when there's no emotional reward. Just execution. This is why most traders feel like they lose motivation. What they're really losing is stimulation. Skill does not need stimulation. It needs structure. Here's the reframing that changes everything. Skill is not what you know. It's what you repeat. Not once. Not when you feel like it. But every session regardless of outcome. Under pressure. Under boredom. Under confidence. This is why two traders can use the same strategy and get wildly different results. One treats rules as guidelines. The other treats them as non-negotiable. The difference isn't intelligence. It's behavior. And behavior doesn't improve with more capital. It improves with awareness, restraint, and repetition. Until you understand that you'll keep chasing knowledge when what you really need is control. Because in the end, the market doesn't pay you for being clever. It pays you for being consistent. Small accounts have a bad reputation in trading. They're treated like a punishment, a temporary inconvenience, something to escape as quickly as possible. Most traders see a small account and think, I can't do anything with this. Too small to grow, too small to matter, too small to take seriously. And that mindset is exactly why the phase fails them. A small account is not a limitation. It's a test. It strips trading down to behavior. There's nowhere to hide behind size, leverage, or optimism. Every decision matters because there's no room for emotional mistakes. Small accounts expose discipline because they remove margin for error. You can't be sloppy and survive. You can't overtrade without consequences. You can't ignore risk and hope size will save you. Every rule you break shows up immediately. That's why small accounts feel uncomfortable. They reflect your habits with brutal honesty. But instead of using that mirror, most traders disrespect the phase. They rush it. They gamble it. They treat it like a lottery ticket instead of a training ground. I'll just take bigger risk until it grows. I can't trade properly at this size anyway. I'll be disciplined once the account is worth something. What they're really saying is, I don't want to practice restraint yet. But restraint doesn't appear later. It's built now. Limitations sharpen execution in a way abundance never does. When risk is tight, you think before you act. When opportunities are few, you wait for quality. When losses matter, you respect your plan. A small account forces selectivity, punishes impulse. It rewards precision. There is a moment in every trader's journey that changes everything. It's not the first win. It's not the first loss. It's the first time size increases. Because when size increases, the market stops feeling theoretical. The numbers are no longer abstract. They carry weight. And that weight does something to you. For some traders, it shows up as overconfidence. A few good trades land back to back. Execution feels smooth. The market seems predictable. You start to feel in sync. And slowly, almost invisibly, your standards begin to slip. You enter a little earlier. You justify a setup that doesn't fully meet your rules. You size up because this one feels right. The danger here isn't arrogance. It's familiarity. Confidence makes mistakes feel harmless. It convinces you that discipline is optional because you're seeing the market clearly. That's when risk stops being measured and starts being assumed. For other traders, size brings fear. Not the obvious kind, the quiet kind. The kind that makes you hesitate on valid entries. The kind that makes you cut winners too early. The kind that turns small drawdowns into emotional events. Every tick against you feels personal. Every pullback feels like a threat. And under that pressure, rules start to bend. Stops move. Plans change mid-trade. Losses are avoided until they're unavoidable. Both confidence and fear lead to the same place. Rule breaking. Not because traders are reckless, but because pressure exposes weaknesses that didn't matter at a smaller size. This is why traders are often confused when their strategy works at one level and fails at another. They assume something about the market changed, but it didn't. They did. Size doesn't introduce new problems. It magnifies existing ones. If you're prone to impatience, size makes it expensive. If you avoid losses, size makes them heavier. If you rely on emotion instead of structure, size removes the safety net. This is the point where many traders start questioning their system again. They tweak rules. They switch strategies. They assume the edge is gone. But the edge didn't disappear. Their behavior did. And this is the line that most people miss. The market doesn't test your strategy. It tests who you become when size increases. Pause. Let the silence sit. Because when money is on the line in a meaningful way, the market stops caring about your intentions. It responds only to your actions. And size has a way of stripping away everything that isn't real discipline. It doesn't care what worked on a demo. It doesn't care what worked when losses felt small. It only reflects who you are under pressure. That's why increasing size isn't a reward. It's a responsibility. And if you're not ready for it, the market will make sure you find out. Prop firms have created an illusion that lures so many traders into a false sense of arrival. You pass a challenge and suddenly you feel like you've made it. You tell yourself, I'm a funded trader now. I'm serious. I've arrived. But passing is not arrival. Passing proves potential. It proves that, under specific conditions at a specific time with a controlled account, you can follow rules for a short period. That's it. What matters, and what so few people understand, is maintaining. Maintaining a funded account is an entirely different test. It's a test of behavior, not strategy. It's a test of who you are when there is real money at risk, over weeks, months, or even years. It's when discipline meets boredom, when confidence meets streaks, when fear meets drawdown. Most traders fail here, not because their strategy stopped working, but because their behavior falters under consistent pressure. They overtrade after a small win. They chase losses after a bad day. They abandon rules when an opportunity feels too good to ignore. They let emotion dictate size and timing. And suddenly, the edge they had during the challenge disappears. The market didn't change. Their behavior did. This is the hard truth. Passing proves potential. Staying funded proves maturity. It's a distinction that is often overlooked because passing feels like success. And success is intoxicating. It whispers that you've finally arrived. But the reality is stark. Most traders don't lose funding because of markets. They lose it because of themselves. They trade like they're still practicing, even when the stakes are real. They believe that having capital solves their mistakes. They think that funding is a reward for past effort, not a continuation of the process they should have mastered earlier. The illusion is so seductive because it's easy to tell yourself a story. I passed the challenge. I'm good now. I just need to scale. But the market doesn't reward belief. It rewards consistency. It rewards restraint. It rewards behavior that doesn't change when the numbers change. And until you internalize this, the funded account will be nothing more than a mirror showing you exactly who you are, magnified by capital. Passing is temporary validation. Maintaining is the proof that your skill, your discipline, and your behavior are ready to handle reality. And that's why so many traders, once funded, fail so quickly. Not because the market is unfair. Not because the strategy is broken. But because they haven't matured into the kind of trader that funding demands. It's a harsh lesson, but a necessary one. Because in trading, potential without maturity is just capital waiting to be lost. The final step in trading mastery is a subtle but profound shift in perspective. Most traders treat skill as a tool. They see it as something external, something to be applied when convenient, something to wield when money is on the line, something to use to achieve results. But skill is not a tool. Skill is identity. It's who you are when no one is watching. It's the discipline that persists in boredom. It's the restraint that holds when fear whispers to act. It's the patience that waits for opportunity. even when impatience screams. When skill is treated as a tool, it becomes conditional. It appears when the stakes feel right, disappears when pressure rises, and bends when temptation calls. And that's why so many traders succeed temporarily but fail consistently. When skill becomes identity, something changes entirely. It is no longer about winning or losing, making money or losing money. It is about process. Process becomes the constant. Outcome becomes incidental. Trades are no longer a measure of self-worth. Equity fluctuations no longer dictate your confidence. Your value is no longer tied to P&L. This detachment is not apathy. It is clarity. It is freedom. Because when you operate from identity rather than results, every decision is made from the same foundation: discipline, patience, and respect for rules. Emotions exist, but they no longer dictate action. Fear and greed may appear, but they are recognized rather than obeyed. And here is the critical truth. When skill becomes who you are, capital becomes a side effect. It no longer drives behavior. It no longer carries the weight of expectation. It simply amplifies what already exists. The trader who operates from identity can manage small accounts without frustration. They can handle large accounts without arrogance. They can survive drawdowns without panic. They can pass challenges, maintain funding, and grow over time because their behavior does not bend under pressure. Skill as identity is quiet. It is grounded. It is not flashy. It is not about motivation, hype, or quick wins. It is about being the type of trader the market cannot break. And that is the point where transformation happens, not because of strategy, not because of capital, not because of external validation, but because skill is no longer something you have. It is something you are. Now, let's step back for a moment. Look at yourself. Not in the balance on your account. Not at the strategy you've been testing. Not at the charts, indicators, or setups you rely on. Look at you. Ask yourself slowly. Let the question sink in. If your capital doubled tomorrow, would your rules survive? Would you follow your plan with the same discipline? Would you size appropriately, manage risk carefully, and remain patient? Or would the extra numbers make your old habits louder, faster, and more dangerous? Pause. Let that feeling sit. If the answer is no, if you know in your gut that the extra money would change how you behave, then ask the harder question. If not, what exactly are you asking for? Are you asking for capital, hoping it will solve your mistakes? Are you asking for leverage, thinking it will fix your discipline? Are you asking for validation, believing it will mask your weaknesses? The market doesn't reward hope. It doesn't reward belief. It doesn't reward excuses. It rewards behavior. It rewards skill. It rewards consistency. And the truth is brutal. If the trader inside you isn't ready, no amount of money, opportunity, or ideal conditions will save you. So here it is. Slow, clear, uncomfortable. Fix the trader, or the market will keep fixing you.